let's get started. Um, I hope you guys can see my screen okay. So thanks for popping on to the webinar. I always like getting this group together because it's the right size where we can answer some questions and really be more interactive than just us lecturing you. So feel free to jot down your questions, drop them into the chat, or pipe up at the end. We'll have some time to answer those. And if you're an industry professional on this call, we'd love to hear your viewpoint as well, because that's the point of this, is to collaborate and share what's working, what we're seeing, change these trends in real time, and break it all down for you in a digestible way, basically the opposite of what the media is doing. So the reason that I'm so optimistic and why I call this an opportunities webinar this year is because this is the most negotiating power that I've seen buyers have in the last few years. And it's changing every month, and it's also become very case by case. Sometimes you have a lot of power to negotiate with a seller. Sometimes you're up against multiple offers, but we want you to not be in an underdog position. We saw a lot of that in 2020 and 2021. And we think that using the strategies that we highlight in these webinars can help you make sure that you get a good deal, but also feel good about buying in this market. We like when people feel good. So it is changing fast, and every webinar we're finding is like a mirror for ourselves, because as we put together the data on what's changed in just the past few weeks, it's been quite shocking this year. Like every time we get ready for one of these webinars, we're like, how has so much changed so quickly? And I think that's something that we've all wrapped our brains around, is that 2023 is going to be a new market every week, maybe every day. But that's not to be intimidating. That's to help you understand that if you're feeling like, wow, this is very fast paced, wow, this is changing really quickly, wow, I feel a little overwhelmed by all the information that's being thrown at me, you should. Like, that means that you're paying attention. That means you're doing a good job. That means your head's in the right space. This is probably one of the craziest markets, way crazier than the market your parents bought in, way crazier than the market your friends bought in just 5 years ago. So if that's how you're feeling, it's totally normal. And then lastly, me and my team, we're real estate investors ourselves. So we're kind of in the same position as you. I know that a lot of the times when mortgage professionals share information with you, you think, well, obviously you're sharing that you want me to buy right now because you have a direct interest and benefit from that. But the viewpoint in these webinars is the one that I'm sharing with you as somebody who's trying to pick up real estate right now. My husband and I own our home here in Reno. We own a true vacation home in California. We own an Airbnb in California, and then 4 other doors here in Reno. And we're trying to buy a property this year. So I'm looking at this the same way you are. And how do I take advantage of this market? What do I need to be aware of? What do I need to be careful about? And how can I strategize? Same with the rest of my team. I do always share this disclaimer that you should not try to time the market, because I just highly discourage it. I think it puts a lot of pressure on you. It doesn't put you in a position to make a good financial decision. The right time to buy, the right time to invest is when it's the right time for you specifically and financially. The reason that I'm giving you market updates in real time is because having the information won't hurt you. Being informed and keeping a pulse on the market will put you in a better position, but this information is no way designed to apply pressure. Every single one of these webinars follows the same format. We start with an economic news update, market update, then the financing strategies that we're seeing work with clients to take advantage of the market and the way it's changing. Basically, why the economic shit would matter to you is how it translates into financing strategies. And then we also want to share the success stories of what we're seeing clients and their realtors do to win. So we knew that this year, the biggest thing, the biggest factor, the biggest variable, the biggest wild card to what would happen with real estate was interest rates. And we had a trajectory. I had predictions that I shared on the first 3 webinars. Everything was kind of going in line with what my crystal ball told me was going to happen. But then we had the bank failures, and that was the black swan event. There seems to be one every couple of years. Sometimes it's a pandemic, sometimes it's major banks collapsing. So I want to explain what happened with Silicon Valley Bank and why it mattered for interest rates. And the end result is good. We're out of the sevens and likely won't go back near them this year. So to break it down very simply, when you as a consumer deposit money with your bank, they don't just hold all the money. They lend it out. They try to make money off your money by giving out loans. But when interest rates on loans were very, very low, like 2s and 3%, there's not a huge profit margin for the bank in lending out money to make other loans. So what they do is they buy bonds, because lending to Uncle Sam is a good person to lend to because he's never defaulted on a debt. And those bonds had good returns, and it was a safe place to put the money. Then the Fed started increasing rates at the wildest pace we've seen in a long time. And when interest rates go up, the return on bonds goes down. And so a lot of banks had a lot of their portfolio invested in bonds. And then the Fed starts doing quick and sharp rate hikes. And then the bank's value plummets. The bank's portfolio plummets because the value of their bonds has gone down significantly. So now when a lot of people come to withdraw money coincidentally at the same time, and the bank needs to access some of the money they put in bonds, they're selling those bonds at a loss, which they were not planning for. It's not really happened in the past. The Fed probably also didn't plan for it. So Silicon Valley Bank started to need capital. And on a Wednesday, word got out that they were trying to raise capital. That spooked all of their investors, who then did what's called a run on the bank and tried to all pull their money out at the same time because they got nervous. Because if they have more than $250,000 with the bank, it's not all insured. So they want to get all their money out. Well, when that happens, the bank starts selling these bonds at a loss, realizes it cannot keep up with the pace of the withdrawals, and it collapses. The FDIC comes in, takes over, shuts down the bank, reopens it under different ownership or under their own ownership. So that's what happened to Silicon Valley Bank, and then Signature Bank, and then a couple others followed. And that put a lot of uncertainty in the market, but made mortgage bonds very favorable. So interest rates improved for mortgages right after the bank news collapse. There was huge improvements in interest rates. We here floated down our entire pipeline. But then the question was, well, is there going to be more bank failures? What's going to happen? And how is this going to affect Fed policy going forward? Because just 2 days before the SVB news, Powell had said that he was looking at doing a 50 basis point hike on interest rates at his March meeting. Well, he didn't do that, obviously, following the bank news, because what is the Fed going to do? Keep breaking shit at all costs? So they only did a 25 basis point hike, which was also good news for mortgage interest rates. Mortgage interest rates are not the same as the Fed funds rate. If this is your first webinar, I want to make sure that's really clear, that you know the Fed funds rate that they've been hiking aggressively is not the exact equivalent of mortgage interest rates. So it does impact them, and mortgage interest rates are not directly tied to the Fed funds rate. They're impacted by it. They are directly impacted by mortgage-backed securities and the demand for those type of bonds. And the mortal enemy of mortgage interest rates is inflation. So what's interesting is that if the Fed is raising their rates to combat inflation, the mortgage world actually likes that. And we sometimes see mortgage interest rates improve on the same day that the Fed has increased their rate. Mortgage interest rates also tend to go down when there's economic uncertainty, which is what happened after the bank failures. So looking ahead now at what could happen with interest rates this year, the big question is, again, what is the Fed going to do? Because they've put, the mortgage industry under severe stress this year. They put the banking industry under severe stress, and arguably the entire US economic ecosystem is under severe stress as a part of the Fed's aggressive plan to tackle inflation at all costs. Those are their words. So if we look forward, I think that deflation, we're already seeing that inflation numbers are starting to come down, and that what the Fed has done has already started to work. Many would argue that they could just stop now and just let what they've already done set and see what happens, see if inflation continues to come down. And I would say that would be quite likely, because we just got the PCE numbers last week on Friday, which is a measure of inflation that the Fed really likes. And it showed inflation has come down to 5%. The Fed's target is 2%. So they're going to continue interest rate hikes or whatever measures they decide will work to bring inflation down until the inflation rating is around 2%. We're getting closer, but 5% is still pretty far from 2%. When we break down those PCE numbers, the increases were in healthcare, there was decreases in food, services, most notably in the PCE was increases in housing, which is really hard for those of us on the inside to wrap our brains around, because we know that housing costs, the price of homes and rents peaked probably in 2021. So we have seen that they've been trending down for over a year. But the reason that's not measured in the PCE is because of the way the data is collected for shelter. So it's collected by the Bureau of Labor Statistics, and they use a system that has two problems. So they poll tenants over a 6-month period and ask them what their current rent is. And so maybe people are reflecting, like in the most recent month, what current rents are, but that's 1/6 of the measure is just the most current month. The last 5 months are also included and have a 1/6 value for each of those months in the PCE number. So only the current month is getting a little bit of influence on the actual data that comes out. Plus, as you probably know, rents don't increase every month or decrease every month. They change when the lease comes up for renewal, which is typically annually. So some of the numbers that they're looking at could be a month old or up to a year old. And that's still being measured as the current shelter cost, when it really could be several months to a year old. So those are the issues with how they're collecting the shelter data. And the shelter data is the biggest piece of the PCE inflation reading. So knowing on the inside that housing costs have gone down, actually, I shouldn't even say on the inside, on the outside, you guys see it too. You see that apartments or new builds, they're all offering huge incentives, like first month's free or incentives towards your closing costs if you're trying to buy. We know that those costs are coming down. It's just not reflected yet in the PCE. We think it will start to be reflected in May, and then we'll see deflation speed up a lot, and we'll get very close to the Fed's target very quickly. Again, would be good news for interest rates, because remember, inflation is the enemy of mortgage interest rates. So as inflation comes down, we see interest rates come down. We also know that there's a great deal of global economic certainty surrounding the bank news and the bank failures. Interest rates overall, all signs point to them trending down this year. But what does that mean if you're trying to buy? Well, you obviously are thinking that's great news, right? Because better monthly payment. And it is. It'll boost affordability. It helps for sure. The reason it could be cutting off our nose to spite our face, if you look at this from an affordability standpoint, is that as interest rates come down, we know that buyers will come back to the market aggressively. Those who are priced out by interest rates will likely want to act quickly to take advantage of the current window when they can afford to buy again. And that will mean a reacceleration of prices, which is not great for affordability. So it's twofold, the benefits and the disadvantages of interest rates coming down as a buyer. You have a better monthly payment, lower cost of borrowing money, but you likely will have more competition out there as rates come down. So again, not to apply pressure or have you make any rash decisions, but something you should be aware of so that you're prepared for it. So as the months of this year go on, what will be the implication on prices, interest rates, and if you do buy, what should you be expecting for appreciation and amortization gains, and how would that compare to if you waited to buy maybe 6 months or a year? Sandy's going to explain that next. So we'll pause for a second because I want to make sure that everyone can hear her and she's all ready.
Hi, everyone. Can you hear me?
Yes, we can hear you good. I'm going to go to the next slide. I think. There we go.
Okay, awesome. So as Shivani mentioned, we're likely to see interest rates come down, but interestingly, the scenarios we've been running about with interest rates coming down, the cost of waiting is still more expensive. So if we look at a $525,000 house with a 10% down loan, most analysts agree that we're either at the bottom or really close to the bottom of the dip in home prices. So moving forward, we're expecting healthy appreciation, somewhere around 3%. Some estimates for our area are even higher than that. But when we look at, waiting 6 months, a year, 2, 3 years, your property value, the purchase price that you're going to end up paying is likely going to be higher. This means that your down payment for the same house will be higher, your monthly payment will be higher, your mortgage insurance on that principal and interest will be higher. So even though we can see that rates will likely be trending downward, your monthly payment is still going to be likely higher. So if you can get in now, and then we can always refinance you later, but you'll be saving because the cost of waiting, you know, you won't be incurring that cost of waiting. So speaking of the cost of waiting, you're likely going to have a larger down payment, which I already mentioned, but there's other costs also associated with waiting. One of which is you won't be paying a mortgage payment in the meantime while you wait until you buy. So you're missing out on your loan paydown. Every month when you pay your regular mortgage payment, your loan balance goes down, your equity increases. So there's an that's called amortization. So there's a loss in your amortization gain from paying your regular monthly payment. The other cost associated with waiting is your appreciation. So like I mentioned, we're likely to see home values continue to increase. So with that, your home value or the home that you're waiting to buy is getting more and more expensive. If you buy sooner than later, that home getting more and more expensive is just your asset going up in value. So you can see here the total cost of these two different losses in 6 months could be around $10,000. And again, this is including your interest rate going down with waiting. But if you wait 3 years, your total cost of waiting could be upwards of $70,000 in this scenario. And these are relatively conservative numbers. So in that same vein, you're required to bring more cash to closing. So waiting just 6 months, you're needing an extra $800 or so more dollars in this scenario. Waiting 3 years, you could be looking at $5,000 to $6,000 plus that higher monthly payment, which you can see there in the bar chart. So just something to keep in mind. A big narrative we've been hearing is that people are planning to wait until interest rates come down. That there is logic to that, but like Shivani said, you're kind of biting off your nose to spite your face because the other parts of purchasing the home are likely to increase and get more expensive.
Thanks, Sandy.
Yes.
So let's talk about what we're seeing in April compared to previous months and what you should do going forward. So the first thing I think is you need to be ready to act quickly. And this is not like I have to find a house and buy it quickly. I mean, when you see a house of interest, I want you to be prepared to act quickly if it's the one for you. And I'll go over how you do that. Offering above list price is back on all the clients that we worked with over the last weekend. They were all in multiple offer situations where the offer that won was above the list price, but we were still able to help them negotiate something cool. So I'm going to show you how you can still get yourself a deal when you're having to go above list price. And then lastly, we touched on this last month and it remains true. You need to be looking to hold the property 2 to 3 years. This is not a market to flip in, and I'll show you that data. So there's definitely still listings where we have the ability to negotiate on price. Listings that came in, overpriced and have been sitting for whatever reason. And we love those, right? We love being able to do a combination of a price reduction with some kind of seller concessions for a 2-1 buy down or a permanent buy down or a credit towards your closing costs. When you think of like seller concessions, it's a wild gamut of how you can use them. Like you can use them to buy your interest rate down temporarily, and that'll make a big difference on your monthly payment. You can use it to buy your interest rate down permanently for the whole 30 years and never worry about refinancing. If you have been, struggling to save up your down payment and you have 3 to 5% saved up, but you don't have the money for closing costs, you can use a seller concession to cover your closing costs. So a lot of these things and this ability to negotiate goes beyond just getting a house at a discounted price. It goes into enabling you to achieve homeownership sooner. And that's the big win in this market. But in the scenarios where we can consider a price reduction or a seller credit buy down, it makes an amazing difference on your monthly payment or your cash to close, definitely more so than a price reduction, but that is not every situation right now as the market shifts. So a lot of listings are getting multiple offers again, as I mentioned. And in this scenario, listing agents are calling me and saying, we were going to take the cleanest offer. We want a clean offer. I can't tell you how many times I've heard that now from a listing agent because they don't want the offer to be like riddled with seller concessions. They want to like be able to compare these easily and see which one is the best offer. And that's fine. I will help them understand how to compare them easily and understand the seller concessions. I just want you to be making an offer that's very competitive if this is the house you really want. So you could give the seller an offer above list price and still get a concession and a better monthly payment. And I want to show you how that plays out. So if we're looking at this graph here, I'm showing you a house listed at $699,000 and making a full price offer, or asking the seller in column 2 to buy down your interest rate. And you're like, wow, that's great. I love what this does for my monthly payment. But shit, I just found out the seller has another offer. And of course, we never know all the details. It'd be great if we knew the other offer was at full ask price or what it is, or whether it has concessions or not. That is the one thing I find that they're willing to share, is that the other offer has concessions or it doesn't. Well, let's go in with essentially a full price offer, but still ask for the credit to buy our interest rate down. And you might be thinking, Shivani, are you insane? Like, I'm not going to pay above just so I can buy my interest rate down. Well, you should actually, because it still gets you a better monthly payment of $140 than if you just offered the list price and didn't ask for any credit. So offering more for the house so you can still have your credit makes sense. Well, you might be thinking that's too good to be true. What happens in the long run? So let's look over the next 5 years. That option is still the best. The seller buy down at list price is definitely the best. Okay. So I misspoke. That is definitely the best. If we could get the house with just for what it's asking, and then also have the seller give us a $15,000 credit, which is basically the same as them selling the house for $15,000 less. That's great over the next 5 years in terms of interest paid and closing costs. But if you make an offer where you ask for the concession, it's still a clean offer because you offered above list. So essentially it's a full price offer. And now you're asking for the concession and you're still saving $18,000 over the next 5 years than if you just offered the list price without a concession. So I hope that makes sense and shows that the strategy can be tailored based on what our competition is, but we can still put you in a position to get a great monthly payment, one that you're comfortable with. So it comes back to my first point, which was to be ready to act quickly. And so I would urge you, if you're going to look at a house over the weekend or tomorrow or today, you ask your lender to run these numbers for you, to run the different strategies you might have in terms of negotiating, to run different down payment options, to know the monthly payment and the cash to close before you go see the house. Because psychologically, that will put you in a position to make a good, sound financial decision, much better than if you were to go see the house, fall in love with it. Then as you've fallen in love with this home and started imagining your family there and your dog in the backyard, you find out that there's another offer up against you. And now you're going to decide how much you're willing to offer and how much you're willing to pay and what your financing strategy should be. Do you see how that doesn't put you in the most powerful position or the best one psychologically? That's what I mean by be ready to act quickly. Know the numbers before you go see the house. Know the financing strategies you might be able to use before you go see the house, and have your agent speak to the listing agent and find out if there's other interest, other offers on the table before you go see the house. In a perfect world. I'm trying to like periodically look at your faces or the black boxes and see if it's like resonating. The black boxes are really giving me like, positive vibes. Okay, so I went over this return on investment last time, so I'm not going to go over the whole thing again. If you weren't on the previous webinar, you can catch it on YouTube. It's uploaded there, no password needed, and you'll be able to catch the whole rundown on these breakdowns. But the last point I said was that you should be prepared to carry this property for 2 to 3 years. When we look at your return on investment, which we do for every buyer that comes in to get pre-approved, we look at, over the next 9 years, if you were to buy versus rent, what could the rent potentially go up to? And then we also look at, like, say you're paying a mortgage over the next 9 years, what would be the amount of the loan that you would pay off? That's your amortization gain. And what would be a very conservative, as Sandy mentioned a bunch of times, we use very conservative estimates on appreciation. What would the value of the home go up? And then we think, okay, well, if you were to sell it, you have to pay a realtor to sell it for you, and you have closing costs. And then during the time that you had the property, you had carrying costs like repairs, maintenance, and mortgage interest. So then we calculate, well, when do you turn green on this investment? And right now, in the majority of cases, we see that happen in year 3, where you could sell the house for a profit. So that's why I say it's not the market to do a quick flip in. There might be scenarios where it makes sense and we would run those for you, but overall, this is what we're seeing. Lastly, and I also mentioned this last time, for my homeowners on this call who feel trapped in your house because you have an interest rate in the 2s or 3s, but you don't love the house anymore and it's not suitable for your family, you should be aware you do not have to sell that house to buy another one. You could keep your amazing interest rate that's very low. You would probably get a very good cash flow on that property because the mortgage payment and the interest rate are low. And rents right now, especially for single family residences, are pretty high. So you could keep that house as a rental and use the profit margin from the rent compared to your mortgage to help offset a higher mortgage payment. Also, if you bought a home in the last 5 to 10 years, you've seen some of the best rates of appreciation year over year that we've seen in a long, long time. So you likely have a lot of equity in that house that you could translate into a large down payment on a new house, so that even though interest rates are higher, your monthly payment would be similar because you'd borrow less. So don't feel trapped if you own a home. You are not trapped. And then in closing today, or at least before we jump into a Q&A, our newest team member, Carly, is going to share a success story we've had with a client recently.
Can you hear me, Shivani?
Yes.
Awesome. Hey, everyone. I get the super fun part. So I want to share a story with you all of the success story of a 22-year-old who decided she wanted to start investing, and she's currently purchasing her first property with us. Our client, she's a soon-to-be travel nurse, which is perfect because she's going to keep the property for a year or two and then turn it into a rental property for other traveling nurses. So she's going to be cash flowing really well in this thing when she moves on, which is great. And I really love this example because I just feel like it's where so many potential buyers will say to themselves, like, maybe right now isn't the right time to buy since they know their career is taking them elsewhere or they're going to be traveling. But she ultimately did her research. We walked her through Washoe County data, and ultimately she went for it. So now she won't have to rent for the next 2 years, while simultaneously she's gaining and contributing to her equity as a first savings account. So I'm just like, I wish a team of women helping me see investment opportunities at 22 years old like she is. We're just so stoked for her. And this success story just follows exactly what we preach, which is that you can use real estate to build wealth.
Yeah, you can and you should. Okay, so some of the questions I've seen in the chat, and it's open now to Q&A for everyone, is that, so Brandon, I saw that you asked about buying a vacation home and debating whether or not you should pay cash for it or go the mortgage route and pay cash for most of it or take a small mortgage. So there's pros and cons, right? Of like, what could you get for your return on your money if you didn't tie it all up in paying cash for the property? Is there something else you could invest that money in that would have a higher rate of return than the interest you're paying on the mortgage? Second home interest rates right now are in the mid 6s. So if there's a place you could put your money that would get you a better return, then you should take out a mortgage. The size of the mortgage, I would say, deviates a little bit from maybe what a lot of other financial analysts would say, because they would look at just the return numbers. I also think that for a vacation home, you just don't want to hate the house because it's this like unnecessary burden in terms of a mortgage payment. So I would judge the size of the mortgage just based on personally how much you're going to feel comfortable paying each month. Get that mortgage payment to a place where on top of paying your primary mortgage, you won't feel that this is a huge burden and inhibits the rest of your life. If you're also going to, Airbnb it out a little bit or rent it parts of the year, then, you don't have to worry so much about how big the mortgage is because you'll have some profit to offset it. When we first got into this personally, we bought an Airbnb in Sonoma County, and you can rent it for longer than 30 days only. You can't do short-term rentals. So we just calculate like how many months of the year do we need to rent this thing out to cover the mortgage? And then it felt like when we were enjoying it for 4 months out of the year, we were enjoying it for free. Karishma, if you're still on the webinar, how would I word which concession? Are you still here? Her question was, how would you word that concession in the offer? But I'm not sure which one it is that I was talking about. But typically, I guess I should just answer in general. When we ask for a seller concession for a 2-1 buy down or an interest rate buy down, the listing price one. Okay, anyways, when we ask for a concession on towards closing costs or towards a 2-1 buy down or towards a permanent buy down, I actually don't have our realtors specify what it's going to. I just say a seller credit towards recurring and non-recurring closing costs. And then for the price, you would, reduce the price on your offer if you're doing a combination of both. Did I answer the question? I hope so.
So I guess my question was more when you said that if someone else is offering like above, so to keep it at the listed price, but you can also offer like a $15,000 like a credit to like kind of like buy down your rate. So I was just trying to figure out like how I can word that in the offer letters.
Yeah. So Krishma, that's really good question, because that's how you make the offer look really clean and stand out. So you're going to put if the house is listed at $699, you're going to put your offer at $714. But then you're also going to put in the offer later that you're asking for a $15,000 credit towards closing costs. And then we're going to call the listing agent, make sure they understand what we're doing.
Thank you.
Yeah, you're welcome. Okay, anyone else? Any other questions or scenarios or wins that you want to share?
Shivani, I put a little note.
Yeah,
in
I'm just
there.
reading this.
So it seems to be kind of a contradiction, and I don't know. None of us have the crystal ball, but both articles are basically describing that these bonds will be liquidated. There will be many that will be mortgages, bringing just so many more homes for sale, which will drive down the prices, supply and demand.
Well, we need more homes for sale.
I know.
We desperately, desperately need more homes for sale. So
Will that
if you
just be
look-
absorbed in the demand that's, we've been behind for over 10 years. Is that right?
Yes, we've been underbuilding for 10 years. We have the largest amount of millennials reaching home buying age this year. I think this could be the help with affordability that we need if it actually happens. I haven't read the article, and so I'm not sure. But if it happened where it brought homes on, I don't think it's possible it brings enough on to drastically reduce prices.
Okay.
But I would actually love it to happen. I would love for there to be a lot of homes for sale so that more people could buy them.
I know.
People could, achieve the American dream.
Totally agree.
It's affordability, I think, is this huge elephant in the room. And I talked about it on a previous webinar that, if you look at wages and you look at prices and you look at interest rates, none of it makes for good news for affordability. And while a lot of the way the media spins this is way too dramatic, because if they say that, home prices have gone up 10%, far outpacing wage growth, well, that's it's not apples to apples like that. If the housing costs, say you make $5,000 a month and your housing cost is $1,000 a month, if your housing cost goes up 10%, you don't also need your wages to increase 10%. That's not the way the math works. You actually only need your wages to increase 2% to cover that increase in cost. I know those are magical numbers and everybody would love to find a place for $1,000, but I'm just using that as simple math. So affordability, the way the media talks about it, is very inflammatory. But that being said, it is still a big problem. And we see it every day when we pre-approve people. And we've seen it here in Reno, because when we looked at the data for Washoe County for years and years, I've been doing this 10 years, the first 8 years, the affordability index for Washoe County was near 100, meaning that the majority of the people who live and work here and earn the median income could afford the mortgage on a median priced home. And over the last 3 years, we saw that fall sharply to 70%, which is sad.
Yeah, I still have a few in my back pocket that just got priced out and they need around 350, and it's just still a tough. You
I'm
look at
hopeful that
condos
as
and
interest
HOAs
rates come
too
down
much,
this year, it'll help those ones that you have.
Yeah. Well, thank you so much. Awesome as always.
Okay, guys, we're a little bit over on time, but if there's any other questions, I'm happy to stay and answer them. Otherwise, we'll catch you guys next month. And if you wanted to do not shout out your question in front of the whole group, you can book a one-on-one with our team. We're happy to go over your strategy. We're happy to help you make a plan to get to home ownership. And, we have your back, basically. Thanks for tuning in.
Thank you so much.
Thanks, everyone.
Bye-bye.
Thanks, everyone.